Good evening. It's September 30, last day of the month, Friday, 8:40 p.m. This is your host, Mark Yu,
Wawi Santos.
and welcome to the Mark Yu and Wowie Show. For those who have listened to our previous podcast, my apologies that our audio was kind of messed up. This time I ensure that my mouth is right next to the mic, so it will be clear. But yeah, welcome to this new episode, episode 57. Okay, how do we phrase this? More negativity, I guess. More losses to come, according to some analysts in Wall Street. So, again, just a reminder this is not an investment advice. Me and Wa, we are both in the healthcare field. We have both the same passion and in the finance industry and investing our hard earned money in the stock market. So, off we go on our weekly review. First one on the list is the American Association of Individual Investors. So this takes into reading what the sentiment is. Bullish meaning people are thinking that the stock market will go up. Bearish meaning the reverse. And neutral means, obviously that explains what it is at that point in time. So as of a couple of days ago, September 28th, there are still more people in the bearish camp, 60.8%, while the bullish people have increased a little bit, 20%. Meanwhile, the neutral camp is hovering around 19%. I guess those people that jump from neutral band to uh, to the bullish bandwagon got screwed again. As of today, the market just raked in its worst performing quarter since at least 2008. And, it's so sad. Uh, you know, if you think that the market will be already recovering, and people were calling the bottom back in June, but looks like there's no bottom yet as we have pierced through today, or I think as of yesterday, of that June low. So now we have just recorded another 2022 low. So what do you think about that, Wawi? Is there any tapping out in terms of bears, or are we still gonna be rolled over into further downside from here on out?
Well, a lot of analysts are positioning towards the downside, especially next year, with more predictions of recession next year,
Mhm.
up to like 70%. But for today, you can look at the real estate sector was the only green sector today, with an increase of 0.99%. So there was a slight um, uptrend early in the trading day, and then it settled back down to the negative at the end of trading day.
Yeah, for some reason, real estate is getting hammered as well. But if people are gonna look at the quarterly performance for the past 3 months, the real estate is actually still one of the, steady decliners. Not that heavily impacted compared to the technology, which suffered greatly since the start of the year, which we're gonna see in a little bit. But yeah, also including some of the um, I would say materials as well have fallen quite a bit, but we're gonna see that in a second. So this is a screenshot, a picture from Bloomberg, saying that the S&P 500 dropped this year. The first 9 months since we just ended the third quarter today is the third worst since 1931. So if you're gonna do the math, 1931. So for the past 91 years, we are delving in the third worst ever performance of the entire S&P 500 for the past 91 years. So if anything, if you have been able to stomach the great decline so far this year, kudos to you. And it's not a pretty sight to see your portfolio deep down in the red every single day. So hanging in tough for sure. How are you handling this kind of downside, Wowie? Are you still looking at your portfolio, or are you just browsing through it, not really trying to think of it, or spend time
Oh, I'm
wondering
l-
about the portfolio performance?
I well, of course, I am tracking. So I'm an active investor, so I am tracking my portfolio. So I'm looking at my positions, and so far I'm trying to think of what I would liquidate, but I have very good conviction so far. But for the end of the year, I might do some tax loss harvesting just for tax purposes. But I continue to buy, and I think today I bought some Procter and Gamble today.
Mm-hmm.
In most of the ones I bought were in my tax advantage account, which is my IRA. So just going towards more dividends, dividend buying. But I did buy some growth stocks like Marqueta that I saw that were low. So I'm still saving money. I'm looking at the 52-week close. I know we're not gonna be able to see the bottom of this. Maybe the bottom maybe next year. But we're not supposed to time it anyway. So I still
Right.
buy. I still buy.
Yep. That's a really good point right there. The timing. I have a screenshot right here, always also from Bloomberg, saying that market timing or timing the market can be costly. So we always see this in phrases here and there from value investing legends, but here is the data that supports that timing the market could be costly. So here's a very excellent chart for those who listen over the podcast. I hope you guys try to tune into our YouTube videos. So here's a chart: hypothetical growth of a $10,000 worth portfolio in S&P 500 since January 1st, 1980, until at least June 30th of this year. So if you have been invested, during that time alone, and you didn't care about getting out, getting in, pulling your investment out, cashing out, and stuff, realizing gains, invested all days, your $10,000 in the S&P 500 have grown into $1.06 million. So if that's the case, if you have stick with it through thick and thin, literally not moving or adding anything to the $10,000. If you tried to time the market and you missed the best 5 days, your return or your portfolio have nearly lost $400,000 just trying to time the market. If you missed those best 5 days during the course of that time. So if I'm going to do the math, 2022 minus 1980, that's about 42 years. So, and if you miss the best 10 days, now your returns have been shrinking more. You have lost about 600,000 possibly in your returns. And if you missed a month, 30 days, the best 30 days during that 40-year period, just a month of that would have cost you nearly 90% of the positive returns, or $900,000. And if you miss the best 50 days, you'll probably, missed a whole ton of the returns. And this is according to asset allocation team and FMR company. So it just means, I'm not scaring any investors out there trying to time the market. I mean, it's to each his own approach in investing in the stock market. So it's a good chart, but during these tough times, it's definitely hard to see every single day that your portfolio just keeps shrinking and shrinking and shrinking. And I know that for a fact that we are invested in a high growth, high quality companies such as Google. It's no secret. These companies are really good companies, but the market is unforgiving at this point in time.
Mhm.
Um, you know, completely reflecting what the Federal Reserve wanted in the first place: joblessness and you know a lot less euphoria in the stock market.
Yeah, there's not a lot of talk in our group as well because the market is down. But that's typical, we're all loss averse,
Mhm.
Just I think the ones that have a strategy are more of the risk averse and more rational investors. So you just have to know what your risks are rather than knowing what your losses are. And that's how you do your valuation of companies, and we talked about that in the past, how we've looked at Apple, Microsoft, and other large companies, and we looked at their balance sheet and balance statement, and you can tell if they're on the positive, and that can reduce your risk. And plus, keeping up with the news, what's developing
Mhm.
regarding certain companies that we're looking at. So
Yep.
to measure your risk, you have to do some homework, some research. So, and that improves uh, your knowledge about the company, and then you will be less loss averse. You will not fear what's happening because the behavior of the market is driven by sentiment, and when the sentiment on the bear side is very strong, you can see a lot of uh, trending down, and that can scare some people.
True.
I forgot who said this, but fear is a stronger emotion than greed. So just know, don't be scared. You did your homework, so you measured your risk, so you know how long you're gonna hold it. So that's what I mean about strategy. You have to know when and how long, and when to liquidate and when to buy.
True. And so here's another important chart that I was able to pull up here from Bloomberg. It just shows that you do not try to fight the Fed or even not attempt it. The problem is if you believe in your company and you bought its stock, it's like some sort of putting up a wager, your hard-earned money against the Fed at this point in time, because the Fed wants to see the stock market go down. So, according to this chart, the previous six bear markets saw bottom arriving amid Fed cuts. So there's no end in sight. Day after day this week, the Federal Reserve governors have come out and they've said that you know they still are fighting the inflation and they'll keep hiking rates. So we don't see. I don't personally see any bottom at this point in time, just because these guys won't stop until the market drops further. Mike Wilson of Morgan Stanley said that he's seeing at least 3,000 for the S&P 500. Now we're at 3,580 something points. So yeah, we're getting there. About how much? 19% more, maybe. Let's do a little math here. 16% from here. And according to this chart from I think Fidelity has this interesting chart. Their data since 1928. So right now we're at 23%, negative 23%. And if we're gonna look into previous history, we still have further ways to go to meet at least 50% correction from the market top. So despite being the third worst since 1930s, we're still possibly expecting more from here. So it's very hard to stay put in this market. But if you're not looking into using your money next year or so, or a couple of years from now, and you think you could stomach the heart wrenching negative returns, then I think you're okay to stay put in the stock market and even buy more.
I agree, Mark.
Mhm. So this is the fear and greed index. Me and Wabi take a look at this every week. So you could tell since August 15, mid August, the sentiment on the stock market has been going down further to the fear territory. What's interesting is we're still a little high in the fear gauge compared to back in May. even compared to June when we bottom. Well, we're actually past beyond that point for June. Sorry about that. So people are now more fearful compared to the June bottom. We're on our way to meet that uh, May, lowest threshold in May. Market momentum, obviously, we're in the negative or extreme territory momentum. Stock price strength, there's no question. We're very weak right now. A lot less. There's not even one, I think, that's experiencing 52-week highs at this point in time. Or I may be mistaken, but there might be some. Maybe Twitter.
Yeah,
They're
not on my radar. The
43
same here.
bucks. Yeah, they're 43 bucks a share, and I think Elon Musk has a bet has a bid at 54 billion, but he's trying to pull away from it. So we'll see how that goes. Definitely, me and Huawei are not in that camp of hoping that they would do a transaction. It's a gamble at this point in time.
Mhm.
The McClellan stock price breadth. So nothing to say here but extreme fear. Put call options, the options market. A lot of people wagering that there's further downside to come. More put buying. So here we go. For the sectors, for the past week, two sectors are up: energy and basic materials. Worst performing, interestingly, is the utilities. Utilities, one might say, is a recession-proof industry, right, Wowie?
Yeah, it's one of the defensive sectors.
Yeah, and real estate for the past week. But if we're gonna look at the quarterly performance for the past quarter, not one sector is up for the past 3 months. So it's been gruesome, terrible. Even energy is down 1.50. The winner all year long is actually down in the past quarter, along with the rest. Not one sector in the green. Oh my. For the
Have you
past. Mhm.
have you had any idea of the volume of trading in the market recently?
Oh, no idea.
Yeah. Um, well, we're trying to see if it's still liquid.
Mm.
So
Oh, we can see that here in the fear and greed, I
probably.
think. The liquidity volume.
I know
Oh, it's the stock price breadth. Yeah. It
I,
says here investors are actively buying and selling them. So yeah, we're actually not liquid right now, Huawei. Look at this. We're down again. Not seen since July, mid-July. So the volume, the stock price breadth, the activity of buying and selling is not that much. So it
okay.
indicates a bearish sign at this point in time.
Okay. So that's a signal
Hmm.
that people are just holding and pulling back.
Yeah. And if we're gonna look at the year to date since the start of the year, energy best performing sector, but just watch out. It already has turned negative for the past 3 months. So its winning performance has now eclipsed by a poor quarterly performance since June. If we're going to take a look at the volatility, obviously for the past 5 days, we have actually been flat. So this is indicating that the market now is getting used to being on a downtrend. There's not much wild ride up and down. It's just going down. There's no other way, but it's just going down. The Nasdaq volatility is actually about flat as well. So market is getting used to the downside and even more.
Mhm.
So more to come, looks like.
Well, in these times of downtrends, that's when in growth companies are very sensitive again to interest rate hikes. So because they can't borrow enough capital for their projects and expenses. Um, but it may still be good to look at certain growth companies. But you know, a lot of the value companies are going down and reaching their 52-week lows right now. So
Mhm.
I'm not saying go ahead and buy them, but you would see that a lot of them are at a good price point right now.
Yep. A lot of 52-week lows or 1 year lows.
Mm-hmm.
Yeah, just a tip,
Uh,
if you're not gonna need that
Google
money, yeah, I
is
think
one of them,
yeah, definitely. Google is one of the best among the bunch.
and Apple. You know, we see a big decline today too. So Apple is also down today, but not at their 52-week low.
Yeah, I wonder, like, Wowie, I wonder what the big shorts out there, like Michael Berry, returns are at this point in time, since they've been wagering and praying that the market would crash at some point. So I think the crash has just begun, but definitely they're probably seeing the greens in their portfolios.
Oh, that would be very. I'm pretty sure that they're profiting from this downtrend right now, um, and they would probably likely profit, you know, during the next 6 months
Yes.
because of what we've been seeing on the signals.
Yeah. Yep. But it hasn't been a good sign for some of the bullish investors out there, like yours truly. It's been a
And yours
crazy,
truly as
crazy year.
well.
So
Uh, e-
uh
even the fixed income people, they're just buying the short-term securities right now because of the higher yield. They're not even looking at the longer term securities.
mhm,
Um, but we'll see how it goes.
right. And here's an article from Financial Times. US stocks record longest run of quarterly declines since 2008 crisis. So this is what we have just mentioned earlier. This is the anatomy of correction. So here is what's quite alarming there in Europe. Or well, UK is already, they exited Europe. So UK on its own, their pension funds are selling assets and tapping employers in rush for cash. So pension funds there, the ones funding the retirement of the older, retired retirees are now getting shortened cash and they're selling at big losses
Mhm.
in their portfolios. So this is not a good sign. They're being forced to sell. And I'm not saying this is the bottom, but being being forced to sell on a loss makes it impossible to recuperate those losses. And yep.
Well, a lot of central banks are also moving their money on US cash reserves right now.
Hmm.
We're in a good position, so the US dollar is still high, so they're moving a lot of their cash reserves into US dollars.
True. US dollar so far this year has been crazily outperforming the rest of the world currencies. It's been registering record highs, as we have discussed on our previous podcast, right, Wowie? It's been
Mm-hmm.
getting stronger because of the Fed rate hikes. That like there is no alternative now, is the US dollar feels like.
Mm-hmm.
So here's an article from Bloomberg. This was just published yesterday, September 29. One of the Federal Reserve governor says that deep recession is not needed to curb high inflation. So you can start seeing now some of the federal governors trying to ring the bell that, we probably are overdoing it already. So, but it remains to be seen and whether what they'll do or not. So this is an interesting chart graph from Tip Ranks. It's free website. So it includes the FANG stocks plus Microsoft. So since the start of the year, Facebook or Meta platforms now, they call themselves, is down nearly 60%, the worst performing among the bunch. Well, no, correct that. Sorry, Netflix is the worst performing at 60.72% down, followed by Meta platforms 59.81 down. Alibaba, I added this among the FANG stocks, is down 46.6%. And Amazon nearly lost a third of their value, 30%. Google is down 27%. Microsoft is down 15%. And amazingly, Apple, they're still up 1.26%. So I guess Apple shareholders are at least, you know, being diversified enough for this incredible onslaught of the stock market.
People will still buy Apple products even if there is a recession.
True. And if we're going to take a look at the money flow, this is published by Reuters on a weekly basis. Investors kept piling out of the stock market. Investors exited nearly 7.3 billion in global bond funds as well, marking their biggest weekly net selling since last month. So there's nonstop selling left and right. It says here by a portfolio manager, energy, financials, materials are still attractively valued when compared to the rest of the US equity market. Valuation multiples of these companies remains low, and they remain to be beneficiaries of the prolonged inflation and interest rate rising environment. So I guess there's still some hope, some bullish analysts saying their thoughts, sharing their thoughts to the to investors like us. So it says here, money market funds attracted investor interest. So this is cash basically. It netted 28 billion last week, their biggest weekly inflow since July. So people are looking into more like safety at this point in time. So I guess that's one way to be safe at this incredible sell-off that's been happening since the start of the year.
Yeah, if you're just looking at some leverage trading on the S triple Q and the T triple Q, you know that there's a lot of options trading and leveraging going on. So we see a lot of options trading, smashing records right now. So people are taking advantage of the volatility.
Right. Well, I guess that does it for this short episode of Mark Yu and Wowie Show. I hope you guys enjoyed that. Apologies again for the audio discrepancy last podcast. And if you would like this podcast, please hit the thumbs up button and subscribe to our channel. Do you have any
And
last message for now, Wowie, to our listeners?
yes, Mark,
Mhm.
stay invested in the market and invest for the long term.
I agree with that. So again, this is Mark Yu signing
And
out.
Wawi Santos signing out.